Thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and there couldn't have been a better time to talk to somebody who looks at the sentiment on the street, couples it up with market intelligence, and runs a very successful portfolio while being on the sell side, because it is starting to come into mainstream conversations that while the indices may have consolidated or the Nifty may have consolidated, the broader end of the spectrum has anything but, and lots of concerns surrounding that at a point of time when India is the cynosure of almost all global eyes. Vikash Kumar Jain joins in to try and put some of the questions that I have into perspective with his answers, hopefully. Vikash, great having you. Thanks for taking the time out.
Thanks for having me, Neeraj.
The pleasure is entirely ours, because you run this very successful. You have this very successful bull bear index, which is a lead indicator of sorts. It's done remarkably well the last couple of times, as we've known as well from your notes too. Uh, Tell us, how do you feel about the tape currently, considering that everybody talks about how India is where the money will flow in, but the index has consolidated to come off a little bit, maybe a percent or two, and the broader end of the spectrum has just gone bonkers.
Yeah, Neeraj. So I think the way we do our research, particularly when I do the market strategy bit here, I believe that what has changed in times, as in right now, in times of today, we are dealing with a time when we have a lot of data. That's very different from how it was, say, 20 years ago or something like that. And I think our way of understanding market should also kind of move ahead with this. So I believe that the problem of today is not data. In fact, all of us are floating on data. Is how to really make sense of it, how to understand the language that is being spoken with that data. And I believe market, when it opens every day, it is trying to talk to us. It's just our ability to be able to understand and listen to it. And that's something why I mentioned that as a foreground is, if you think about what has happened from the time when Nifty made a top, which was sometime around 20th, 19th of July or so, to now, that's a good 6 weeks period. There has been, if I were to tell you at the start of July that, Neeraj, from here in the next 6 weeks, crude is going to go up 15, 17%. Dollar index is going to rise more than 5, 6%. India will be worried about rains, that is, and food inflation kind of print going, higher than our comfort, and many of those things happening. Then most of us would have said that, and we started with a point around. So since you mentioned the sentiment index, sometime around that period, we got a pretty extreme 99% kind of a bullish signal on the sentiment index, and we wanted to trim down risk. In fact, that's the report that we wrote. The title was Trimming Down Risk. But we did nuance it, saying that this time the signal is coming without a extreme point on valuation, so we don't know how this signal will kind of settle itself out. And I've been simply amazed that in this 6 weeks period, the sentiment has gone down to neutral, to almost about lower than 50% bullish, just at the start of sometime last week. And the market is only corrected from top to bottom by 3.5, by 4% at max. That's actually the way in which it has kind of digested the gains. To me, unless something dramatic happens, this market definitely has more steam left. I think that's something that, and I am maybe this is not how one feels when they look at the mid cap and the small cap space, and I'm trying to be more large capish in my thought process, because I'm trying to read the overall market, and we should not forget that still 70-75% of the market cap come from large caps. So yes, I mean, there is a lot of kind of euphoric talk that we hear amongst retail, which is linked to small cap and mid cap. But on a larger market perspective, I think this market has digested a large part of that sentiment extreme. So, whenever there is an extreme on the sentiment, there are ways in which it can correct. We've seen points like, for example, I remember, say sometime around Jan 21, we hit a close to 98-99% kind of a sentiment extreme just before budget. And the market cooled off by falling 9-10% in the following 9-10 days. So that's one way of cooling off sentiment. The other way could be like we've seen more recently, where in 6-8 weeks, the market is simply being more sideways to negative, but not dramatically falling. That means it is kind of adjusting. And if you were to look at the events that it has digested, I think there's something seriously, more steam that we can read here in terms of where the market is. So I would say that I'm still in the camp that I would want to see glass as half full. And perhaps we've not yet reached that point. There are other reasons also that I can bring out more from a fundamental perspective. If I were to look at, if you look at valuations, valuations are not comfortable, but they're not super extreme. If you look at something like a PE, Nifty is a little below its +1 standard deviation to historical average PE. And I say historical average, I'm using not 10 years, but 15, 17 years. If I were to look at a bond versus equity valuation parameter, that's well below what could be an extreme peer point. So typically when I say bond versus equity valuation, I'm looking at India's 10-year bond yield and Nifty's 12-month forward earnings yield. Typically what we have found out is whenever the difference goes to, that is, earnings yield falls more than 2% discount to bond yield, that's the extreme. We are right now more like 1.6% or so, percentage points or so. So there is still some room left, So I mean, all of this, perhaps, if there is a quick 10% rally without earnings catching up, then we could get to that extreme.
Sure.
But all that I'm saying is that there is nothing alarming at this point of time, unless there is a macro event that plays out globally, which we are not really able to see at this point of time.
This crude uptick and the fact that there have been production cuts extended, which may lead, and the fact that either the US SPRs or otherwise are not full, we are approaching winter, so on and so forth, could it lead to a tone of higher expectations around inflation, and therefore the markets believing that, oh, the Fed may actually not stay on pause, but what if they hike? And could that bring down the risk appetite a little bit? Could it impact Indian markets too, or not quite?
Yeah, I think so. The good thing is I also happen to be the oil and gas analyst, so I think I can wear that hat and answer some of those questions. But essentially, if we look at what has happened at crude, this time there is a combination. There is a little bit of a movement which has happened because of expectations that Chinese stimulus is possibly coming. And secondly, it's simply been because of supply. Typically, if crude prices go up due to supply worries, then that's not something which is good for the global economy. Okay. However, the reason why this time it has gone up is not because supply has gone out of control, is because OPEC is trying to control supply in a manner that they are able to get a respectable crude price, whatever the definition of respectable to them is. Now, given that backdrop, firstly, although I'm a longer term bull on crude prices, I don't believe that we have a much bigger runaway rally immediately for a couple of reasons. I think Saudi is pretty cognizant of the fact that the global economy there is some kind of fragility around the global economy. So if crude prices were to kind of sustain significantly above $90 for a longer period, then Saudi will come back and take back a part of its cut that it has done till December, because that's something that they can review on a monthly basis, number one.
Right.
Number two is, I think what is happening in China. Now, there is this talk, although that's something which is never transparent, that China has built a lot of inventory. And it'll be interesting to see what they do of this inventory at higher crude prices. If they were to release it, I think that's really the interplay that Saudi has been trying to get onto. If they keep production at this low level till December, that would mean that on a YOY average basis, OPEC output is down notably versus last year. And that is basically creating space for inventories, excess inventories, and possibly in China to get digested. Now, once that, I think a lot of these things will limit upsides on crude, and Saudi would have achieved its aim of getting to a respectable price. So I would say that somewhere in the region of 75 to 90, 95 is the range. For India, the good range will be 75 to 85. For Saudi, they would want an 80 plus kind of a range. So, that's really the fight that we are kind of dealing with at this point of time.
Okay, so crude most probably does not throw a spanner in the wheels. Markets
Immediately.
Not immediately. Okay, over the long term, I heard you say that you are constructive on oil prices.
See, I think there is still what has been a big worry for me is despite oil prices being so strong, US production growth over the last 1 to 2 years has been tepid. Uh, if we look at requirement of incremental oil, even over the next few years, that's easily going to be 1 to 1.5 million barrels per day growth in a normal growth year for the world. To get that incremental supply, if US production growth doesn't catch up, will be difficult if we look at where OPEC is. There is, of course, this 1.5 million buffer that Saudi and Russia has currently. If we eat into that in another year or so's time, and there is natural decline from old fields, because the problem with this commodity is it's like running on the treadmill to stay at the same place. If you don't run fast enough, there's natural decline, because that's the nature of production in fields over here. That natural legacy decline from old fields is something that has to be replaced every year. And that's if investments do not pick up. And given the whole talk around ESG, it's not been so easy for investments to pick up around upstream in oil. And that is where my problem is. So from that perspective, it is not going to be easy over a slightly longer term period. Yes, we'll have periods where it cools off. See, there was a lot of worry around supply, which did not play out like that when the war hit us. And that's why we went to 140, we cooled off. Now we are at a respectable crude price. Producers would want to keep it at this level for some time. But if their excess capacity of 1.5 million barrels get eaten away, there's only so much that they can do.
Okay.
And this, I fear, could be a kind of cut which we saw around 2005-06 done by OPEC, which led to very high prices later on. So that's what my worry is over a slightly longer term.
Okay. Hopefully we move on to a lot of other alternates, though I know it's not happening anytime soon, but be that as it may. Okay, now Vikash, talk to us about, therefore, if the basic idea is that we are not in a precarious situation right now, even if the markets don't rally, but if they kind of stay sideways, where is it that, as to all your clients who might be talking about what to buy into India next, because I hear most global pension funds that we speak to or otherwise wanting to increase allocation, who are not present wanting to do allocation. So I'm presuming that money is wanting to come into India at the right price. When your clients are asking you about where to buy and what to buy and why to buy, what is your answer?
Yeah, that's a relevant question. So there are a few things which are happening let me just shift horizons. When we look at the longer term, a more longer term period, and then I'll come to the more immediate part of it as well. What is happening is what we do not recognize. There's a lot being talked about the economy in general and all the right things which are happening with the Indian economy. What is not enough spoken about, and what I want to also kind of talk more about when I speak to foreign investors, is the Indian equity market itself, the depth and breadth that the market provides. If you try and look at all the large markets globally, India, in terms of market cap, is somewhere around the fourth biggest market or so. But if I were to look at number of stocks, say above $1 billion or above $5 billion, India is also the fourth, fifth biggest market. If I were to also look at the most liquid set of stocks, like we have almost 150, 200 stocks which trade, 150 plus stocks which are over $5 billion. I think we have some 600 stocks or so which trade, 500 stocks plus which trade over $1 million a day. When you look at some of those numbers and when you compare with other markets, it gives out certain points about Indian market. Number one, it is clearly a stock picker's market. To have liquid opportunities and to kind of choose from 400, 500 stocks is something which is very exciting for stock pickers globally. That's something which is not fully recognized. Why I say it is not fully recognized is most of the flows that come to India are still not flows coming to India, because 95% of the foreign flows are non-India dedicated. So investors who are putting money in those funds are not directly putting money into India. I think over the longer term, that is what will fundamentally change. As our economy possibly crosses the size of both Germany and Japan and becomes the third biggest economy before the end of this decade, then the market also will, that 500 stocks that I'm talking, 600 stocks will become 1,000 stocks, which are trading over $1 million a day. Imagine that kind of a breadth. That's something which is rare to find. If you were to look at markets in Asia, for example, if you want to go to Taiwan, you're playing a couple of sectors only. If you want to go to Korea, there also you're only playing a few sectors. Here in India, what I also figured out, if I were to look at the most popular foreign benchmarks, in India of 11 big sectors, there are 8 or 9 sectors that command more than 5% weight in the index. That's almost the highest. That's the most spread out that is there. So here, we offer opportunities for all kinds of thought process and investment styles. So given that as a thought process, although we do like to talk macro, there's always pockets of the markets which has opportunities, which we should not be forgetting. But this is still not fully appreciated by global markets in general. So that is where I believe the opportunity lies as the market becomes, as the economy size grows and the market becomes even deeper and broader versus what it is, which is itself pretty big right now. I think India will be able to attract money on its own. That is something which is going to be the single biggest equity market link change, which will happen over the next few years. On a more immediate basis, Neeraj, I think what has happened, which has still not been fully appreciated by the market, is events over the last few weeks have panned out in a manner which should delay the chances of a rate cut. If I were to also look at what government has been saying, the focus on controlling inflation is far, far bigger. And also globally, now the way yields have gone up, clearly we are preparing for no rate cut anytime soon.
Agreed.
If that is the case, then this underperformance of banks is actually a bit perplexing. In my sense, and my guess is that full appreciation of a delay in rate cut is something, perhaps it happens whenever the next central bank event is, or when we get to see bank results which do not see any kind of major name contraction as the fear could have been if there is a rate cut sooner. Then I think excitement in banks needs to come back, and that's where maybe the sideways opportunity is. So that is something that we clearly believe where the opportunity, that's also a large section of the market which is not that inflated in its valuations.
But does it perplex you, Vikash? Because usually, sorry to interrupt, but just one quick follow-up, because you're talking about banks. The most common belief would be that if large money is coming into India and if it is passive in nature or not India dedicated, then it's not choosy and it will follow the benchmarks. And if it's following the benchmarks, then money should go into BFSI and banks. And here we have HDFC, Kotak, ICICI, SBI, the best names, having not done anything in the last 4 months while money is come in droves.
Sure. In fact, the answer to your question was in the question itself, because you said what has happened is, if you look at last month, that is particularly July, where we already have ready data for, August, where we have ready data for, August data, we don't have July data, we have, where there was a significant increase in foreign inflow. Despite India dedicated funds making only about 5-6% of the AUM, they made up almost 40% of the inflows that came into India.
Okay.
So bigger part of the foreign inflow was not non-India dedicated here, therefore more stock picking sort. And that is why banks have kind of not played out that way. And still in August, to an extent, foreign flows have not been as strong as July. Yes,
true.
they've been. So, and it's been more domestic money being plowed into the market in terms of DII, actual money coming in. That's why we've been a little bit more kind of a bottom-up kind of a market. I think the answer to all of that is simply what has happened to dollar. the way dollar has rallied from middle of July, in general, EM flows have not been that strong. I think if that part of the move plays out and we get to a sideways to a more corrective dollar phase, that's where we'll see more non-India dedicated kind of flows, because all EMs getting into inflows, India also getting those inflows, and perhaps that'll have a bigger part of banks. Plus, in addition, I think some bank results calming nerves that, NIM contractions won't be that bad.
Okay, sorry, and please finish the rest of your answer. So you were telling me that banks, and the last 3-4 minutes on the conversation before we let you go, but you were saying that banks are probably a pocket that could be a candidate for some bit of upsides. What else, Vikash?
So in my portfolio, where we've somehow been able to manage a reasonable performance, we are overweight on banks and we are overweight on energy. Now, energy is because there are certain parts of the space which are pretty beaten down and where we can find reasonable valuation part of it. I think both of those sectors are reasonable valuations. The stuff that we are quite worried about in general or not so positive on is consumption in general. I think with that same theme, we are in a higher for longer rate environment, which means sectors with very relaxed valuations may take a longer period of derating. I think we've been in a longer period of derating for consumption in general. And secondly, I'm still not convinced about significant further upsides in IT because of the similar kind of reasons. Like, I would much rather be a little bit more India focused as compared to, because the worries whenever they will come out, they are going to come out largely from external shocks. So, I'm still not convinced on IT because those stocks, although, you look at where they were in 2021 and say that, yes, they have corrected a lot. But if you were to look at a slightly longer period of valuations, they are not, attractive in terms of valuations.
No, that's a very fair point. I was about to ask you about the second largest weight, and you gave me that answer. So, Vikash, lovely there. Before we wrap this conversation, Vikash, are there pockets where you're extremely contrarian and they could be trickling down the market cap curve as well? Not that I'm asking you to comment on micro caps, but are you contrarian on any of the mid-sized pockets?
So, in terms of the way we express our opinion more emphatically is through the portfolio, which is a large and liquid focused portfolio. So there we do not consider the less liquid names, but within that portfolio, I have right now zero weight in consumption. So that's obviously very anti-consensus. So, that's the bit which is clearly where we believe that, there could be a much better entry opportunity than where we are right now.
Lovely talking to you. Thanks for those lovely insights on liquidity and the breadth of the market, as well as on energy, which is a very relevant conversation today as well, but maybe for the near term. Vikash, thank you for taking the time out, and we look forward to talking to you around the time of your November, around India Investor Conference.
Thank you. Thanks for having me.
Now, the pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.